Let me give you reasons not to worry about the debt now. First of all, the effective interest rate is low. The effect of higher rates has been muted because much of the long-term borrowing took place when rates were at rock bottom levels. And there's an analogy to mortgage rates here. Recently, I was at a conference and I asked people, about 300 people in the audience, raise your hand if your mortgage rate is below 4%. Now, guys, can you guess how many hands went up? Below 4% is basically 90% of the audience raised their hand. So because everybody refinanced their 30-year mortgage in the US when rates were really low and we were fighting COVID. Now, the analogy also applies to corporations. Corporations extended their debt when rates were low, and to a certain extent, some people argue not enough, the government did the same. So the effective interest rate that the government pays on the debt is not that high. Now, you may counter that the amount of debt is so high that the total dollar value of the interest expense is skyrocketing, and that's true, but the Fed is expected to cut rates. So if the Fed cut rates, long-term rates might not bite as much if there's an opportunity to just dodge these higher rates environment and refinance later when rates have come down, right? This assumes that short end and long rates are correlated, which is not always true. But one thing is for sure, lower short-term rates will provide immediate relief for the stock of short-term debt. So there's that. Second reason not to worry, the US has reduced its debt to GDP ratio before. This is not, like by historical standards, this is not irreversible. The US significantly reduced its debt burden after World War I, after World War II, and in the 1990s. There are three ways to reduce the debt to GDP ratio. Number one, reduce the deficit. Spend less or tax more. Now, this is going to be difficult in the current environment, but that's one way to reduce debt. Number two, reduce the cost of the debt, right? So reduce the interest rate. And the Fed is taking interest rates down. It really wants to, for sure. And number three, grow. Grow the GDP, because we're talking about debt to GDP. And you need to grow the GDP mathematically at a higher rate than the real interest rate, the interest rate after the effect of inflation. Now, some of you might say, wait a minute. You know, the narrative says inflation is also a way to get rid of the debt burden. It is potentially a fourth way, but it doesn't always work. So if I owe you $100 and I can print money, I can just print the money and pay you back, right? With worthless or worthless paper money. That's the intuition. But there are nuances for government debt. It doesn't necessarily work that way. What you need is, if you're going to use inflation, if you will, it's not really how it works, but if you want to depend on inflation to repay your debt into devalued dollars, you also need to keep interest rates low. Because typically inflation pushes interest rates higher, which puts the cost of the debt over time higher. So there's these interaction effects between inflation and where interest rates are that introduce nuance to just inflating the debt away, which is what the narrative says. So what Blarina explained to me was you need to do financial repression. So you need to have high inflation, but cap the interest rate in one way or the other. Force the banks to buy the debt, force a central bank to buy the debt. In some of the historical episodes, actually put explicit caps on interest rates. Now, this is harder to do in the current environment. But if you can do that, then yes, you can improve the debt to GDP situation. Third reason not to worry. There is strong demand for US debt. This might be the most popular argument. US exceptionalism, the reserve currency. There's a shortage of safe assets in the world. And debt to GDP ratios are rising everywhere. So the US debt may remain the cleanest dirty shirt, and the USD, the dollar, may remain the reserve currency held by central banks and used for financial transactions. So if the demand for US debt is always there and you can keep rates low enough, then the cost of the debt doesn't balloon. And if you have a little bit of inflation, it kind of works itself out. So it's one of the most popular narratives about why we shouldn't worry about the debt, at least for the US, because the US is different. is how the narrative goes. Number 4 reason not to worry, we can live with higher debt levels. Now, this is one of my favorite stories in economics. Guys, the story of the Excel error by Reinhardt and Rogoff. It's a very, very famous Excel error by 2 very credible, outstanding economists. And there's a headline that I'll quote in the paper, but it's from Bloomberg. It goes, Reinhardt, Rogoff, and the Excel error that changed history. And there's another one, even better, the Reinhardt-Rogoff error, how not to excel at economics. Okay, so in their original study, this very famous study, Reinhardt and Rogoff concluded that countries with debt to GDP above 90% experienced negative growth on average of minus 0.1%. So debt is bad for growth. Here's 2 famous economists, and we got to get the debt under control, and then clients worry and they ask us about the debt. That's sort of the narrative. However, there's another team of academics that tried to replicate this study, and they fixed a few errors, including a major Excel error, and the result was countries with debt to GDP ratios above 90% historically have grown by an average of 2.2%, which is actually pretty decent growth. So Reinhardt and Rogoff had not selected the entire row when they averaged the growth figures. They forgot Australia, Austria, Belgium, and Denmark. And I think Canada too, because it's alphabetical. They just did the average not on the entire row, just on part of it. So as a caveat, despite the obvious error, I like to talk about this Excel error, but despite this error, the academic debate continues, right? So you can't just say debt is fine, it will never impact growth. You know, that's a broad and all-sweeping statement. My conclusion is that it's not a given, especially for the US, that high debt means low growth. It depends. And the US is in a unique situation given the demand for its debt. Okay, 4th and last reason not to worry, during periods of declining debt. And I know the feedback I've gotten from you is when you show us the research, tell us the trade. You know, you want to talk to your clients about research, but also about trade ideas. This is just on the margin risk on, because during periods of declining debt, after World War I, World War II, and during the 90s, stocks perform better than bonds on average and better than stocks versus bonds overall. So the average return for stocks versus bonds, I'll show in the paper, during periods of declining debt to GDP ratio is 10%, and the full sample is 7% outperformance stocks over bonds. So it's actually, by historical standards, just naive analysis, risk on.